Hi there, I'm Lindsay Biscaya. Welcome to Market Call. David Driscoll is on the show today. He's president, CEO, CIO, and founder of Liberty International Investment Management, and we'll be taking your questions on global equities. Here's how you can reach us. You can call us toll free, 1-855-326-6266, or you can send us an email at marketcall@bnnbloomberg.ca. And David Driscoll joins us now. It's good to have you. Thanks for joining us.
Thanks for having me, Lindsay.
So you talk about, we're a couple weeks into 2026 so far. You're seeing investors really diversifying so far this year. Is that right?
Sure, because over the last 3 years, we've had a momentum market, and that's where you can get the rise in the Magnificent Seven, artificial intelligence, gold stocks. But now we're getting to the point where things are starting to get a little bit tired, and money is starting to move into more value-oriented names or those that have been forgotten for the last few years. So when you look at overall markets, the Russell 2000 small cap index is up 8% year to date. The S&P 500 is up 1%. Japan is number 2 at 7%. The emerging markets index is up 6%. Canada is up 4%. And then you've got the laggards of Europe at 2%. The global developed market at 1.5%, NASDAQ, and the S&P up at 1%. So we are starting to see movements away from what's been working the last 3 years into more diversification. And at the end of the day, investors moving towards what's cheap, what provides good long-term valuation.
And so what is cheap? What does provide good term, like long-term valuation? Are there certain sectors you think people should be looking at?
Well, I think investors should be diversified across the board because that's the best protection against any downside. The other thing that investors have to consider, and what I've always been harping on these shows, is to think about return on invested capital, because that's really where Buffett started, and that brings into the law of diminishing returns. Because you can look at the gold sub-index was up 98%, but over 20 years, it's only up 1%. So I think it's more important for people to get away from the emotions of chasing returns and trying to create a portfolio for themselves that's going to get them through both the good times and the bad times, where they can stay of the game so that if the markets were to fall 30 or 40%, they're not going with it.
Okay, I take your point on that. Is it also maybe a good idea to diversify away from just the U.S. markets or North American markets, like looking overseas maybe? I noticed in some of your picks that we'll talk about later today, you don't just stay in North America.
Well, you have to think from a logical standpoint, Lindsay, that there are 8 billion odd people in the world, and North America only makes up 550 million. So there's a lot going on outside of Canada, North America. And the other thing is that last year, both the Canadian and the US dollar fell against a basket of global currencies. So a lot of foreign investors or international investors, both pension funds or large institutions, they're putting money into the US markets for US tech, but they've been investing elsewhere in the world to get the, shy away from the US dollar exposure so that you can get a total return, say 10% on a stock, but if the home currency rises 5 or 10%, then your total return's 20. But if you're investing in a US stock where the currency last year went down 7%, then you could have a 10% return minus the currency and only have a total return of 3.
Okay, lots to talk about. We're going to take a quick break, though. We'll be back with David Driscoll of International Investment Management, taking your questions on global equities right after this break. Stay with us. Hi there, welcome back to Market Call. David Driscoll joining us on the show today to answer your questions. And we're going to go straight to an email, this one coming in from Lauren. And it reads, David's opinion as to Motorola, please. Thank you. David, what do you think of Motorola Solutions?
Well, Motorola's done quite well over the last few years. If you think of their business, they've got software management, video government, all of the walkie-talkies and ability to communicate, 911, et cetera. 2 of the 3 businesses are doing well. It's the software management that's giving them a big issue. And that's really because of AI is starting to have an impact on software overall. that how much can you charge on the software side if AI is going to take away the ability of pricing power? So that's where the company has struggled a little bit, and it is a large portion of their business. But the other side of their businesses are doing well. So it's a good long-term investment. We don't own it, but certainly, definitely an opportunity for people to buy more as the stock has come down recently.
Okay, speaking of long-term investment, that goes to our next question as well. This is another email coming from Margaret, and it reads, would appreciate your guest's analysis of OpenText. What are the company's prospects over the next few years? Will AI be a positive or negative for the company? It's been the biggest laggard in my portfolio over the last 5 years. Is it time to sell and move on? Okay, so let's start with that first part. OpenText, what do you think over the next couple of years for this company?
Okay, so just as I spoke of previously, we've got software issues. Software companies are having a big problem right now. Their stocks are down anywhere from 20 to 50% in the last year, simply because they can't get the pricing that they were getting before. For 20 or 30 years, people would be reliant on buying the software, paying the annual license, and it gave multiples of roughly 40 times free cash flow. Now you're starting to see AI impinge on the software businesses, which is going to reduce their ability to sell as much or the ability to create as much profit. So you can think of 40 times free cash flow in 2023 for software companies. That has now gone down to roughly 16 to 18 times today. So until we get further proof that AI is going to put software out of business completely, these stocks are going to struggle for probably the next couple of years until they start to prove that they actually can provide something over and above what AI may be taking away from them, and then see where we go from there. If not, then they could be the buggy whip that the automobiles replaced.
So just to go to her last part of the question there, obviously this is her personal portfolio, but do you think wait and see, like a hold to see what happens over the next couple of years, or just to sell and move on?
Well, last year in the summer, we were selling our software stocks, says we don't have any belief that they're going to be any great performer in the next couple of years. And then, of course, we have to worry about the future. So we exited our software companies completely.
Okay. Move on now to a caller. Elliot is calling in from Hamilton, Ontario, the question. Hi, Elliot.
Oh, good afternoon. Even better than this CPKC hookup crossing international borders, which might be a problem, I'm intrigued by this UNP Norfolk Southern link-up, which would be like all across the country, Pacific, Gulf, Atlantic. Great potential there, I think. Would you start a position today in UNP? Thank you.
Okay, thanks for your question. Union Pacific, what do you think, David?
Well, the biggest challenges are, what are these railroads carrying? I mean, CN Rail has suffered in Canada because one of the largest shippers of automobiles, and of course the tariffs are causing them issues. The economy is going to drive how well the rails do. And right now, the US economy is doing better. So the stocks started to pick up again from its April lows, but still not seeing anything that's shooting the lights out. So again, in Union Pacific's case, they're hauling agricultural, automotive, chemical products as their biggest transportation. And it's just a matter of whether the economy is going to continue to grow and the opportunities are there for the rails to be able to take advantage of that. But for now, they've been pretty much going sideways, and I don't think there's any catalyst right now. If an investor wanted to take a position on the rails, then they just have to be prepared to be patient.
Okay. We're going to go to another caller now. This one calling in from Sierra Vista, Arizona. Hi there. What's your question?
Hi. My question is on Roper Technologies. They moved from industrial hardware to software. Matter of fact, you talked about them before. However, there's something called artificial intelligence. How risky is it now? Because I look back and you came out of Dassault Systems, another software company. What's the fate of Roper?
Wow. Look at that one-year chart. Okay, thanks for your question. What do you think the fate of this company is, given everything that's happening with AI right now, David?
Well, as this is almost like I'm on auto repeat. Roper's facing the same situations. A lot of their software is in the healthcare industry. And again, until they can prove that they have a product that is in need that AI can't take away, then the stocks are going to languish, and Roper's no different.
Okay, we're going to go to another caller. John is calling in from Ottawa with a question. Hi, John.
Hi there. I'm a first-time caller. I'm curious to hear your thoughts on Brookfield Corporation, and specifically on how successful you think they are likely to be or not to be on all of this AI global infrastructure growth. I know they're well aligned with competing in that sector. So I'm just curious to know how successful you think that they would potentially be, and I guess just the company's prospects going forward for growth itself.
Okay, thanks for calling in. David, what do you think?
I'm sorry, Lindsay, I didn't catch the name. Like,
Brookfield Corporation.
What company?
Yeah, Brookfield Corporation. How well do you think they stack up against everything that's happening right now?
Well, this is really an issue of thinking of trends moving forward, especially for financing and underwriting new ideas. So Brookfield's always, they're the old brass can. So the head office, the major corporation, is going to be focused on their pools of private equity. They've got private debt. And then again, you've got the utility side of the business where their underlings, such as the Brookfield Renewables, the Brookfield Business, et cetera, are going to be sitting there trying to fund all of these new growth areas. So think of data centers. They're going to be involved in providing funding for that. So when you think of Brookfield or Blackstone or KKR, these, like the banks, are going to be necessary moving forward to fulfill all the trends providing the financing. And then, of course, Brookfield, the Papa Corp, is going to be getting dividends coming up from the subsidiaries, as well as getting fees based on the different private equity, private debt types of funds that they have. So we own Brookfield, we've owned it for a long time, and we do believe that they're going to have a role to play moving forward. So it's a good buy at this time.
A good buy. Okay, we're going to take a quick break there. David's going to stay with us, though. He will be back right after this break to answer more of your questions on Global Equities. Stay with us. Welcome back to Market Call. David Driscoll joining us to answer your questions. And we are going to go straight to the phone lines now. John is calling in from Toronto with a question. Hi, John.
Hi, I would like your guest views on Netflix. Would he buy it now for a long term? Would it be dead money for the next couple of years? Or, well, I'd like to hear his thoughts.
Okay. All right. Thanks, John. David, what are your thoughts on Netflix?
Well, the big battle going on right now is content. And this is where Netflix's earnings came out a little weaker because subscriber growth has started to slow down. And now it's a matter of how can we continue to get people sitting in front of the TV watching or streaming our shows. So you've got lots of competition out there. Ways to be able to grow their business is going to be through not just movies, but also live events and sports. So that's what still needs to be done for them to continue to move the needle higher. We've had that correction. The stock's down 8% year to date. Still trading at a hefty valuation of around 33 times earnings. So I'd certainly wait on this one if I was interested in buying to get further indications that they're moving in the right direction, that they're going to be able to sustain their earnings growth, because that's the challenge right now.
Okay. We've got another caller. Diane is calling in from Blue Water, Ontario. Hi, Diane.
Oh, hi. Hello. My question is on GE Aerospace. I've owned the stock for quite a while. I've added to it. I beat on everything, and it's done very well. It's raised guidance, and stock goes down for some reason. So just wondering what's going on here.
Wow. Yeah, it's had quite a good run at the end of last year, but it has dipped a bit. David, what do you think is going on with GE Aerospace?
Well, let's not forget things don't go straight up forever. So it's had a 46% return in the last year. similar to a lot of the aerospace companies. I mean, we own HEICO out of the US, HEI, and in Canada, CAE, and they've had wonderful returns as well because everything's setting up for demand for commercial aircraft growth, but also increase in defense spending is going to have the other side of the defense business providing the opportunities for all of these companies. So don't worry about short-term volatility. It's more important to be focused on what's to come. Always be thinking forward. And the aerospace sector is going to be in huge demand moving forward because you can see all these countries around the world starting to increase their military spending. And of course, what comes with that are new contracts and better earnings.
So you're saying this is a hold for now then? Wait and see what happens.
Yep.
It sounds like, yeah, positive
Definitely.
future. Okay. All right. Jean is calling in now from Montreal with a question. Hi there. What's your question?
What do you think of MDA Space at its current price? That's my.
Okay, thanks very much. Yeah, MDA Space, a lot of big news coming out of that company based out of Ontario. What do you think of that one? And I'll get the current price for you if you want it.
Oh, it's at $26.90 right now. It's a small cap. Small caps are coming into vogue right now. So the last year, up 35%. Again, you're getting robotics, satellite systems, geointelligence technology to the space industry. So you think of Elon Musk wanting to put more communication satellites up there around the world. This is falling into MDA's bailiwick as well. And as I said previously with the aerospace companies, this is their time. So it's worth owning at this point. As I said before, we own HEICO and CAE, so we're not into it because that's too much diversification. But if the investor likes what he has, then continue holding it.
Okay. All right. Back to the phone lines now. Alan, rather, is calling in from Guelph with a question. Hi, Alan.
Hello. My question for David today is Bell Canada. Are you ready to buy, David? Thanks. I'll hang up.
All right. Thanks so much for that question. Disclaimer, we, of course, BNN is, Bell is the parent company of BNN, but go ahead. What do you think of BCE?
Well, the problem with the telecoms in particular is they're debt-laden and they weren't able to get pricing power off their 5G movements. Now we're going to be coming up across 6G, so they're going to be spending more on spectrum, but they're not getting the revenues rising. But at the same time, you still have that 20 to 40 billion in debt sitting there you have to pay interest on. It's part of the reason why BCE had to cut their dividend last year. And it's also a reason why the telecom space really hasn't done anything. I mean, even year to date, they're slipping. So it's still not a great entry point because year to date, as of, where were we? Just a few days ago, most of them were down anywhere from 1% to 6%. Mm-hmm. So it's not something that I want to get involved in. We do have Cogeco in our tax-free savings accounts. The yield is good. The dividends are growing at a hefty clip compared to the other telcos where the dividend growth has only been in that 1 or 2% range, if at all. You can think of Rogers Communications has not raised their dividend in the last 10 years because they're having to allocate a lot of capital expenditures that are cutting their free cash flows from being able to reward the investors with higher income. So the entire telecom sector for me, both Canada and the US, is a pass.
A pass. All right. We are going to take a quick break here, but when we return, we will take a look at some of David's past picks. That's next. Stay with us. Welcome back. David Driscoll joining us today on Market Call. And we're going to go through some of David's past picks from March 25th, 2025. So, David, we will start with Chubb, dealing with insurance. This company deals with insurance. So, recommended at $291.40, now up to $301.66, 3% return, 4% total return. This has done pretty well.
It was doing a lot better until later in the year because now we've got pricing pressures on the insurance side of the business. It's why a lot of the insurance companies are actually down year to date. But when you think of P&C insurance, which is property casualty, you have to think of the combined ratio, which is comparing how much you selling in policies and how much you're paying out in claims. And when you think of Chubb relative to AIG, Allstate, Hartford, et cetera, they have the lowest combined ratio at 86%. So what it means is that for every dollar of policy that you're writing, you're paying out 86 cents in claims. And that's an old Warren Buffett joy, is to have that 13 cents per dollar of policies built that you can invest on your own. And that's what gives them the leg up against their competitors whose combined ratios are essentially in the 95% range. So they're making more money on their underwriting businesses. They're very good at what they do. They're globally oriented. And even though it hasn't grown that much this year, it has in the past. Long-term returns are good, and we continue to buy the company at this price.
Okay, next one is TC Energy. Back in March, it was recommended at $69.79, now $76.23, total return of 14%. You still holding this one?
Oh, definitely, because if you look at natural gas prices, having gone up 40% just since the beginning of the year, they sold off their oil pipeline business, the Bow South, which was essentially Keystone, and kept all the natural gas pipelines. They also own a piece of the Bruce nuclear power plant. So you're getting a decent dividend. Dividend growth is probably in the 4 or 5% range, so it's staying just a little ahead of inflation. And it's a name that we want to have because more pipelines being built for infrastructure uses both in Canada, the US, but also Mexico, keeps this name a buy for us.
And lastly, I'm not sure if I'm going to pronounce this right, but Lagercrantz Group AB, back in March, it was at $227. Now it's at not dollars. This is based out of Sweden. Now it's at 195. What is that?
Swedish krona.
Swedish krona. That's what I was going to say. Krona. Return 14%, total return 13%. I mean, we talked earlier about diversifying away from North American markets. What do you think about this company right here?
We did a half a position when we opened it last spring. The stock's come down, so now we're ready to allocate the other half. When you think of the grid, so think of artificial intelligence, you want to have exposure to that, to the chips, to infrastructure, to utilities, to financials, and then you also want to be focused on serial acquirers, companies that are constantly buying smaller businesses. So think of a plumbing company, a family-run plumbing company that after 40 years in business, they're now ready to retire, sell the business. These are the types of companies, Lagercrantz is one, that will gobble them up at prices on a public or a private market of roughly 6 or 7 times EBITDA, compared to trying to buy a publicly listed company at around 20 times EBITDA. So you can grow your own business organically by 3%, tack on these acquisitions, add another 3% revenues, and now you're growing your revenues and your profits at roughly twice the rate of global growth. These companies, I think Lifco is another one that was on one of my top picks the last show. The Swedish economy is doing well. Growth rates are supposed to increase. And this is why we're allocating more capital towards the Lagercrantz and Lifco purchases. Swedish krona was up 15% against both Canada's and the US last year. The Swedish economy is expected to grow around 2.6% this year. So this is a great time to dollar cost average.
Very interesting. All right, we're going to take a quick break here. We will be back with David Driscoll of International Investment Management, taking your questions on global equities right after the break. Stay with us. Welcome back to Market Call. David Driscoll joining us to answer your questions. And we're going to go straight to the phone lines. Ray is calling in from Pickering, Ontario with a question. Hi, Ray.
Oh, hello. Happy Friday. David, I'd like to add to my technology positions in my tax-free savings account. And with all the capital spending we're hearing now towards the AI data center build-outs, I'm wondering if you see Cisco as a good buy at this time with its current price for long-term hold. Thank you.
Okay, thanks so much, Ray. So David, we've been talking about some software companies today. Thoughts on Cisco?
Well, Cisco is mostly hardware, but also getting into software security. The interesting fact is that it has finally gotten back to its break-even price from year 2000. So it essentially took 25 years to get back to what the price was back in year 2000. It's been climbing higher. I mean, it was up 23% in the last 12 months. There are lots of differentiations and companies to choose from. Cisco's not on our buy list because we own Comfort Systems, we own Lam Research, we've got Analog Devices. So in our portfolios, our tech exposure is about 10 to 20%, but it's definitely diversified within that tech component. Cisco should do well. The only downside would be, again, are they able to keep up with demand, and are they going to be the prime providers within the data centers? If they've got the upper hand and pricing power, they'll do great. If they don't, then they'll just trundle along with everybody else.
Okay, thanks for that. We're going to go back to the phone lines now. Marshall is calling in from Toronto with a question. Hi, Marshall.
Hi. Thanks for taking my call. I've always thought of Nestle as being one of my most admired companies. It seems, global companies. It seems to be on sale now, and I'm wondering what your guest's thoughts are.
Okay, thanks for that question, Marshall. Another international company. David, what do you think of Nestle?
Well, Nestle is getting hurt because of all the weight loss drugs and people changing their diets away from ultra-processed foods, because you've got candy and chocolate, other things that Nestle is providing, which is why they've been struggling. They're not the only one in that sector, because last year the consumer staples group, if you look at the S&P 500, was up all of 1% last year. So there's another big change coming into the economy right now, where people are moving to protein, fruits and vegetables, and avoiding those ultra-processed foods, and that's hurting the Unilevers, the Nestle's, the Hershey's of the world. So expectations are for lower revenues and obviously a reconfiguration of their PE multiples, and probably the stocks continuing to trend lower.
Okay, back to the phone lines now. Alfred calling in from Mountain View, California with a question for you. Hi there, what's your question?
Yeah, thank you for taking my call. Your take on Berkshire Hathaway, please. It's been trading sideways for a while now. Thank you.
Okay, thanks for that. David, Berkshire Hathaway. Yeah, not a ton of movement. What are your thoughts?
Well, as I spoke of Chubb earlier, I mean, Berkshire's biggest holding is Geico, which is insurance. And right now the insurance companies are facing headwinds because of price competition. They're not able to raise their prices by 15% a year as they had in the past few years. And this is going to have an impact on Berkshire in a big way, because Geico is a huge component of their business. And then you've got the sell-off happening with the retirement and the exit of Warren Buffett. And then the questions are whether Greg Abel can continue to keep the money flowing in and the growth happening, or is it going to be a company that's going to sit there and either go sideways, struggle, or find new ways to allocate their cash and build a new business? But right now, that's really the explanation as to why the stock's done pretty much next to nothing. So as insurance goes, so will Berkshire.
Any indicators on which way you think Berkshire might go?
I think the biggest issue right now, and here we get into the law of diminishing returns again, is it's so large of a company and they're sitting on so much cash that it's very difficult for them to make acquisitions and move the needle or invest in businesses that are going to cause the company to be growing their revenues at roughly a 5% clip because they're just so large that it's very difficult for them to be constantly watching their revenues grow, and naturally their earnings as well. When you think of the return on investment, their ROIC is around 8%. The cost of capital is at 8% as well. So they need to get the bottom line growing through new acquisitions to be able to generate that free cash flow that's going to continue to keep the money coming in that will allow them to grow their business.
Okay.
So I'm a little wary on it right now.
Okay, good to know. We're going to go back to the phone lines one last time before we take a quick break here. Ian is calling in from Winnipeg with a question. Hi, Ian.
Yeah, I'd like to know his thoughts on Kraft Heinz on the NASDAQ for 2026, and also can it sustain its dividends of about, I believe, 6.83%, and also it's not carried on the Bloomberg ticker tape anymore. Should that be telling us something?
Okay, thanks for that. Yeah, the yield is 6.9%. But what are your thoughts, David?
Yeah, well, as I said earlier with the Nestle comment, you've got old brands that the younger generation are not turning to. You've got to take, with the FDA changes of taking out some of the red dye, which is going to be in a lot of those products. Something like Kraft Dinner is not getting the kind of pull from consumers, even though they're watching their grocery prices double. So it's giving you an idea that a lot of the brands are getting old and they're not able to be revitalized. Now, from a free cash flow standpoint, don't do this to me.
Is your computer stuck?
They're generating cash from operations of about $4 billion. Capital expenditures are around $1 billion. So there's lots of free cash flow to substantiate or pay out that dividend. Dividend payout ratio right now is sitting at 70%. So they're not in a situation where they're running out of cash. The only thing that could hurt them would be if they started to see sales tumble and that free cash flow started to fall.
Okay, we're going to take a quick break here, but we will be back with David Driscoll of International Investment Management, taking your questions on global equities right after this. Stay with us. Hi there, welcome back to Market Call. We are going to go straight to the phone lines once again because we've got Jack calling in from Oakville, Ontario with a question for David Driscoll. Hi, Jack, what's your question?
Good afternoon. Thank you for taking my call. David, I'd like to diversify away from Canadian and U.S. markets. I'm thinking investing in Indian market for a long time using like ETFs, ZID or XID. What would be your thoughts, your recommendations? Thank you very much.
Okay, thank you. Let's start with those XID or ZID for ETFs. David, what are your give the thumbs up?
Yeah, I like the thought of India because their population, more than half, is under the age of 30. So if they ever get their infrastructure efforts in gear, then they can be growing their economies a whole lot faster than North America. So the opportunity is definitely there. So when we look at the ETFs that the viewer described, first thing they have to look at is what are the holdings? So with the XID, you're getting an index of an index, which is the iShares India 50. And then with the ZID, you're getting actual companies. And then the next thing to look at would be the fees. So that XID, the expense ratio is 1%. And with the ZID, the expense ratio is 0.72. So just from a very quick look, the ZID would be the better of the two because it's cheaper and you're getting better diversification because it's not just the Nifty 50 that the ETF is investing in.
All right. Very interesting stuff. We're going to move on now to Al, who's calling in from Manotick, Ontario with a question. Hi, Al.
Yeah, good afternoon to you both. David, I'd like your thoughts on Amazon, please. It's been bouncing around a little bit, so what do you think? Thank you, bye.
Okay, thanks so much. David, what are your thoughts on Amazon?
Yeah, there's a lot going on with the Mag 7 right now. Year to date, Amazon is up 3%. They've also started to announce a lot more layoffs yet again. And that's really to pay for the kind of CapEx that they're going to be spending. When you think of the hyperscalers for the AI, it's these data centers of which Google, Amazon, and Microsoft are involved in the leaders in the game. Amazon was lagging both Microsoft and Google last year simply because their AWS was falling behind. It wasn't growing to the degree that it was. But again, it's a play on data centers, quantum computing. We do favor Microsoft. That's in our portfolios. We're looking at Google. Amazon, I just have difficulty with because the other side of their business, which is the e-commerce, margins aren't growing because of all the costs that are involved of getting to the final footsteps to the doorstep. And I prefer that the viewer decide on either Microsoft or Google. I think they're the better opportunities moving forward.
Okay, good to know there's some alternatives there. We're going to go to the phone lines. Diane calling in from Sault Ste. Marie with a question. Hi, Diane.
Hello.
Hi, what's your question?
The question's on Saputo. I bought it in the mid-20s, and I'm not sure if I should hold on to it or sell it.
All right, thanks so much for that. Saputo now at 41.70 today, Canadian. What do you think about whether it's a hold or a sell?
Well, this is where we have to look at the fundamentals and the valuations and ask oneself, why did I buy it in the first place? And where do I think it's going to go? Because it's not about the past, it's always about the future. Companies in turnaround phase, they suffered for pretty much 5 years dealing with the milk side of the business. Cheeses have been selling well, but it's the milk and their US operations was causing the bulk of the issues. Again, we're getting down to dairy and products that what is the demand going to look like moving forward by consumers. If they continue to want to have cheese, then by all means, Saputo is the best one to be able to have access through global markets because they're not just in Canada, US, they're also in other countries in the world. Trading at 27 times earnings, I understand that it's pretty expensive for a food company. So perhaps maybe if the viewer has doubled her money, she may wish to sell half and allocate that capital towards something else. And then basically, if you've doubled your money, sell half, then the rest is free. So no matter what happens to Saputo's share price afterwards, she's already taken her profits off the table.
All right, thanks for that. Hopefully that answers the question. And we're going to go back to the phone lines. Anita is calling in from Markham, Ontario with a question.
Good afternoon. Thank you so much for taking my call. My question is on United Health. Your thoughts on that, please, David. I don't own it. Do you think it's a good entry point to get in right now? I'll hang up and listen to you. Thank you.
Okay, thanks for your question, Anita. Yeah, United Health going through some tough times. What do you think about it as maybe a buy at the moment?
Well, the tough times have pretty much been actuated not only by a change in the CEO, because the previous CEO was starting to fall short. There were fears that they were overstating some of their revenues. So there's going to be an internal investigation. And then at the same time, you've got the US federal regulators or just overall trying to cut healthcare costs, which is going to be a challenge for the HMO companies like United Health. So it came down from its lofty $600 level to around $355. I imagine it's going to sit here for a while until the new CEO, who was a previous CEO, is able to turn the ship around or things start to change within the healthcare industry in the United States, where the HMOs can get their pricing power back, because that's essentially what has happened and what's kept the stock down. So to me, this space is really not a guarantee, and it's probably part of the healthcare industry that I'd avoid right now.
Okay, we're going to take another quick break right now. That's actually all the time we have for callers today. But when we return, we will take a look at David's new top picks. That's coming up next. Join us Monday on Market Call. Mike Vinokur will be on the show. He's a portfolio manager and senior wealth advisor of Propellus Wealth Partners, IA Private Wealth, and we'll be taking your questions on North American large caps. And if you miss Market Call, you can always check out our daily podcast. You can find it on iHeartRadio and other platforms, and you can also watch full episodes on our YouTube channel. And David Driscoll joining us for this today's edition of Market Call. We're going to go through some of David's top picks for this year. So, David, we'll start off with the first one, Stantec Incorporated. What is it that you like about this company?
It's an architectural firm that's really involved. And again, if you think of the grid of what trends are right now, is to create environmental improvements, or they can do remediation if there are wildfires or floods or mudslides. One example is they just got a contract with the Scottish Water Enterprise to upgrade Scotland's waste and wastewater, or water and wastewater infrastructure. Stock was a high of around 180. It got a little ahead of itself in the fall, and it's come back down into the 140 range. So it's a good opportunity to come into a company that, compared to all of the other architectural firms, is holding its own, if not doing a little bit better. And where it's trading right now, where it should be trading based on a PE multiple over the next couple of years, is probably in that 17, 18 times range. So good 10% growth expected moving forward, both in profits and dividends.
Yeah, the annual dividend growth, 7 to 10% range. That's quite a bit.
With the free cash flow companies that we own, a lot of them are in that 10 to 15% dividend growth range, which is about double what publicly listed companies worldwide are. So it gives you a good idea, not only of the quality of the company, but the ability for them to be able to generate cash that can be reinvested for investors or for retirees, more money to cover their living expenses.
Okay, next pick is Littelfuse Incorporated. This is a U.S. company, I believe. Tell us more about this one.
Yeah, Littelfuse, I wish I had picked this back after April when it was down around $140 a share. Now that we're up around $300. But their data center business is gaining traction. They make fuses and sensors. So if you're going to have any electrification going on, Littelfuse is going to be in demand. It's done well so far this year because it is a small cap, so it's catching momentum. But it's just that all of their businesses are now starting to hit on all cylinders. So now the price is starting to be justified at where it should be trading as opposed to where it was.
And you talk about, I know you mentioned small caps earlier as well. Do you think 2026 really is the year for small caps, or do you just think people should be investing more this year in small caps?
If interest rates, Lindsay, if interest rates don't rise, then small caps should do well. They and growth stocks like the Mag 7 really do well when interest rates come down. So we'll find out in May if Trump politicizes and forces the Fed to cut rates. That'll be good for the small caps. But you also have to take a look back over the last 10 years that small cap stocks have underperformed. So this could be their time for the next couple of years.
Okay, so a wait and see approach, like so many things these days and heading into 2026. Yeah. Lastly, your last pick for today, I'm not sure if I'm going to pronounce this one right, Keyence Corporation. Is this a Japanese company?
Yep. Factory automation has been in the doldrums for the last couple of years, but it's now starting to turn, and the cycle is starting to move in their favor. The stock is up 5% year to date, so it is starting to begin its turnaround. And basically, the company is machine vision technology on assembly lines. They make code readers, laser markers, measuring systems, sensors. So this is the demand that's going to be coming down the pipe when new manufacturing or assembly lines start to come for all the new products moving forward, such as robots. So demand is starting to pick up, and this stock is really cheap relative to where it's been. So the Japanese yen, interest rates are rising. The yen should start to rise with it. So hopefully we can not only get a price improvement, but also have the Japanese yen as a tailwind on the currency for total return that that should do well.
Well, yeah, I mean, Japan and its currency and economy have been going through such interesting times over the last couple of months. Like, I know a caller earlier was talking about India as a potential market. You liked India. You like Japan as a potential market as well. Are there other, like we talked earlier about diversifying away from North American markets, are there other specifics, maybe in Europe or something that you are looking towards for 2026?
Well, the biggest returns last year came from the emerging markets. So think of the BRIC countries, Brazil, Russia, India, China, Mexico, Latin, South America, Southeast Asia. That index was up close to 30% last year. So it even beat many of the main ones. And the reality is that if you think of currencies like the Brazilian real or the Mexican peso, they were up close to 15% against the US dollar last year. And because those countries, a lot of their debt is denominated in US dollars, if their home currency is starting to rise with US dollar falling, you could see the flip side coming where the S&P dominated for 10 years. The S&P could underperform for the next 10 as emerging market indexes could do much better.
Okay, we'll have to leave it there. That is David Driscoll joining us today. Thanks so much for your time. Enjoy your weekend.
Thanks, Lindsay.
And thank you for watching Market Call today. We will see you next time.